Hello everyone, welcome back to another video, and in today's video we're talking about inflation and your savings. Before we get started, make sure you subscribe to the channel and click the like button. Okay, so what's inflation? Simply put, inflation is the measure of the rate at which the average price level of a group of products or services in an economy increase over a period of time. So what does that actually mean? Well, it means that in general, you would expect prices of products and goods to increase over a period. However, it's the level at which those prices increase that is important for you to take note of when thinking about your savings and planning for the future. So do you remember when you were younger and you could buy a can of Coke for half the price it is today? And that's why everyone says,
Well, everything is so expensive, these corporations are taking advantage of us.
well, not exactly. Companies actually need to keep ahead of inflation in order for them to keep making money. So what does that mean when it comes to your savings? When inflation increases, it means that the money you have today will buy you less tomorrow. Meaning if you have your money left in a low interest bank account that is tracking below inflation, it means that that money is actually being devalued as the day goes on. Let's say you have $100 in a saving account that pays 1% interest rate. After a year, you will have 101 in your account. But if the rate of inflation is running at 2%, you will need $102 to have the same buying power that you started with. Although you're making an interest, which is great, you're still losing buying power because inflation is going up at a higher rate than the interest rate provided to you by your bank. This is why you need to have a high interest saving account which is tracking at inflation or ahead of inflation. Now, if you have a standard saving account, it's unlikely that you will be tracking ahead of inflation or at inflation because usually saving accounts are really safe and you stand to not lose money over a long period of time. So if you actually want to make more money than inflation, it means you have to be a bit more riskier with your savings. So this might mean you might have to invest into stock market, indexes, or real estate in order for you to actually make enough of a profit for you to be ahead of inflation. Before you start saving your money, you need to ask yourself, when do I actually need to get access to this money? If it's a short-term saving and you just want to put money aside, then I would discourage you from putting money into riskier investments. In this situation, I would completely disregard inflation and just focus on putting money aside. However, if you're looking to save money for the long term, then you definitely need to pay attention to inflation. It is important, however, to remember that if you're putting your money in anything that isn't a standard savings account, it's going to be a riskier investment. So although you stand to make more money in the long term, you also might lose money in the short term. So that's why, again, it's important to make sure that you're going to keep your money in there as long as possible. In my opinion, the best way to do this is by using an index fund. Now, what's an index fund? Let's say you wanted to invest in every single company in the United Kingdom or in the United States. Now, in order for you to do that in practical terms, it would cost you far too much money and it would be so difficult for you to track the performance of each and every company. However, with an index fund, you can choose which market you'd like to invest in and then choose the best index for you to put your money in. Investing in an index fund means that you put your money into a wide, diverse portfolio rather than an individual company. Index funds will still give you good enough returns over a long period of time compared to normal saving accounts. In addition, you will not only get the benefit of the share price of the companies you've invested in, you will also get paid dividends over a certain period of time. And putting all of this together, you definitely get a lot more than you would if you stayed in a traditional saving account. Remember, interest received on any investment will always get tax applicable to it. So make sure that when you're setting up an index fund, you set it up, if you're in the UK, you set it up using an ISA, and if you're in the US, you set it up using a Roth IRA. So you need to make sure that going forward, every time you're putting money away, you know exactly where your money is going and what the likely outcome of your money is going to be. Don't just accept the saving account that is provided to you by your bank. Make sure you do your research, think about inflation, and more importantly, how long you need to put your money aside. The longer, the better. But critically, if you're just starting out, just start saving money. Don't worry too much about inflation, index funds. Just find somewhere where you can put money away and over a period of time, learn how you can make that money work for you. I will be covering deflation in another video, But I hope you guys enjoy this one. Make sure you subscribe, like the video, leave some comments below on future content that you'd like to see, and thanks for watching.